who's kind of the group that's going to pull the trigger on this? Is it going to be another country? Is it going to be the market itself? Bond investors?
It's
the Fed?
It's likely going to come. My bet would be the global currency markets. I would look for a dollar sell-off to come here. It's a type of thing that could happen at any time. The current negotiations on the fiscal cliff get real nasty, as we had back in 2011 with the budget negotiations. That could trigger a dollar panic right then. If you look at what happened in 2011, we had a dollar panic. A dollar plunged against gold holders, rallying tremendously against the Swiss franc, and then the Swiss intervened to tie the Swiss franc to the euro, and our markets were redirected to attack the euro, which helped to prop the dollar. But the dollar is the elephant in the bathtub of sovereign solvency. The global markets are waiting to pounce on it. Whatever happens in Washington with this fiscal cliff, if they resolve it, people will see that it really did nothing meaningful to reduce the deficit. If you wanted to avoid the hyperinflation, you'd have to balance the gap-based deficit, but it would also indeed be very, very hard on the economy. There's no way we can escape bringing the system into balance and not taking a hit on the economy. But the economy's not growing at the moment anyway, it's turning down again. There's a lot that could be done to restructure the economy, but no one in Washington is looking at that.
I've asked you before, what will the Fed do to protect their right to print money? Let me ask you from a historical perspective, what happens to central banks who manage hyperinflated currencies like Zimbabwe or Argentina? What historically happens to them? Are they just the new central bank that does a new currency?
It's tough to tell exactly how it will evolve. The Fed will be the key element here because the Treasury's not going to be able to raise the funds it needs to pay its obligations, and the Fed's the lender of last resort. As they come in and lend it, they monetize the debt, and that accelerates the growth in the money supply. But you'll see a heavy pickup in inflation before you see the growth in the money supply. You look back at quantitative easing 2, I think that was a little bit of an experiment by Mr. Bernanke. And what he did there was he monetized Treasury debt. He monetized, in effect, more than the net issuance of the Treasury for over a period of 9 months or so. First he jawboned it. If you look at how he's described it, first you hit him with a jawboning, that'll have effect, and then you start to do it.
Mm-hmm.
The result was a weaker dollar. That's what he wanted. He wanted to debase the dollar. As the dollar weakened, oil prices rose. A direct causal relationship there. That is oil denominated in US dollars. As oil prices rose, gasoline prices rose, we started to see a pickup in inflation. We're still living with the effects of that. Mm-hmm. QE3 really hasn't come into effect yet, but it will, and as it does, you'll start to see an intensification of the inflation rate. You'll start to see flight from the dollar, increasing flight from the dollar, not only people domestically, but holders of dollars outside the United States. When you look at the money supply, and I still track M3, which the Fed stopped reporting back in 2006. I used largely the Fed's numbers on that.
They said it was too expensive to keep track of, right?
Right. Yeah.
They're a profitable group as well, right?
Yeah, they had enough money to buy AIG. In fact, all the tussle over the TARP deal, $800 billion. The day after that was agreed to in Congress, Mr. Bernanke just created $800 billion to go play with the markets abroad. It was Fed can create any amount of money it wants to.
Yeah. You think the Fed's going to be able to blame the government? Because everybody looks at the problem as the White House, Congress, our national debt. No one really even knows about the Fed.
Well, the White House, the government's clearly involved here. I mean, if we had lived within our means, If there'd been fiscal discipline, we would not be facing this.
Yeah.
It's that simple. And it's for both sides of the House, not just the Republicans, not just the Democrats. Both are equally culpable here. It's much easier as a politician to give people money and hope for their votes and tell them they've got to take it back and you're going to drive them into recession and then say, give me your vote. Actually, I think if someone in this last election had gone to the American people and outlined the crisis and said, look, here's where we are, here's what we've got to do, it's going to be costly, the economy's going to suffer for a while, but we can come out of it, our dollar will be healthy, we can rebuild our economy. And Americans have been through difficult times before, but nobody as a politician wants to face that.
Yeah.
And nobody we saw in this last election, other than someone like Ron Paul, actually even talked about it.
When you look at the going forward for the next 2 years, a lot of people, they've got families, so they're buying, food supplies and maybe some weapons and some gold and silver. What about people who said, okay, I'm prepared for this, but I want to manage this as best as possible, so I want to try to use it to an advantage. As far as I know, you are not an investment advisor, so a little disclaimer there for everybody. But what are some ideas for people that say, hey, you know what? This is going to happen. I accept this. I'm buying physical gold and silver. I'm buying some long-term food storage, paying off debts. Do you think people should pay off debts or hyperinflate out of it with gold and silver?
Well, in theory, inflation wipes out your debts. That's why it's always favored by the Democrats that had a big base with the farmers who like to see inflation because that helped them get rid of their debts. Problem is that you're also going to have with this a very difficult economic time. And the timing here can't be too precise. Nobody knows all that's going to happen, all the counteractions that'll be taken. I mean, as the dollar starts to sell off, I'm sure that we'll see some direct intervention in the currency markets. We may see institution of capital controls. I would look simply first to make sure that I had everything set. Now, when I say everything set, I'd look at having my core assets protected in hard assets that are liquid, such as physical gold and silver. Have some funds in the stronger Western currencies, such as the Swiss franc, the Canadian dollar, the Australian dollar. I've been talking about this hyperinflation since 2004. 2004, I was looking at it out at 2019. Now it came into 2014. That's holding.
Yeah.
And we're coming up on 2014 pretty quickly. Had you done this back in 2004 when I was first talking about it, you would have done very well in holding gold. I mean, the gold's outperformed the Dow Jones Industrial Average, I think, for every year after year for something like the last 8 years.
Mm-hmm.
But that's not the issue. When you look at gold, you'll see it as the inflation picks up. You'll see it at 10,000 an ounce. You'll see it at 100,000 an ounce. You may see it at $1 million an ounce. You don't take a profit and say, "Wow, look, I made $1 million on it."
Yeah.
Although it may be somewhat ahead of inflation, it's not a profit. What it has done, it has retained the purchasing power of the assets that you put into it. What it's telling you is that that's what you've lost in the other assets that you didn't protect. So that if you can ride out the storm, come through this with your basic, if you protected your basic assets and wealth and kept them liquid and in hard assets, you'll be able to take advantage of some of the most remarkable investment opportunities that anyone has ever seen in the post hyperinflation era. I'm just going to take a closer look at
Word. No problem. In closing, John, do you think we're looking at a complete fiat currency crisis once the dollar goes? Will the whole world panic? I mean, who's going to want to hold another fiat currency, especially with the euro? I mean, if the euro and the dollar, the two biggest currencies, are having issues, the whole world might flood into gold and silver.
Well, again, the dollar is a big problem. We've bankrupted ourselves long term much more severely than anyone else. I think the dollar is going to, and currencies that are tied to the dollar, dollarized countries, are the ones that will see the biggest problems. And those that are tied to the dollar, always, of course, can always break away from the dollar. The dollar is big enough that as this breaks, I mean, people will be fleeing to other currencies, almost any other currency. But in the dollar at the moment accounts for something like 80% of the global currency transactions, one side or the other. It's a global reserve currency. I'd expect that to disappear as the crisis begins to intensify. Things such as oil are priced in it. I would expect to see that change. But basically, you're going to have a new global currency system. I would expect it'll have some backing in gold to make it saleable to the public, but the crisis will be largely that of the dollar. I don't see that, even with the euro. Don't forget that cornerstone of the euro is the German economy, what used to be the German mark. If they were to break that up, I figure if you could somehow take the pieces of the euro, and they effectively destroyed all the sub-currencies when they put the euro together. But over time, there's no way to adjust the relationships between the countries in the euro. If you could take it apart, let all the old currencies float for a couple of weeks to seek their own market value, then put it back together, I think you'd find the euro would be maybe double its value.
That's interesting.
Right now. I mean, the drachma's not going to have much value, but the mark will.
Yeah.
The mark is heavily undervalued in a relative position here. So I would look at the euro longer term, however it gets resolved, as not being a dollar-like currency that's going to collapse into hyperinflation. The dollar will go first, and once that goes, you'll have a reorganization of the global currency system, and what comes out of that's anyone's guess.
Prior to other currencies collapsing, I mean, I guess every situation is different, and we're not saying it's going to happen tomorrow, so it could happen in 2 years. But, I came to your office today, and everybody's living like everything's fine. They're at Starbucks, they're going to Disney Store, the Apple Store. Then you look at the economic situation and what you're describing, you're like, wow, we're going over the cliff, if not already over it. What were other societies like prior to currency collapse?
Oh, all sorts of variations, but normally people don't expect it, and that's common. And when it gets really bad, people are creative. They find ways to work things.
Yeah.
But the inflation here can be so rapid that something like TIPS, inflation-adjusted treasuries, won't be able to adjust fast enough.
Yeah.
I mean, if you had a settlement on a bond, and it took a day or two before you got your funds, the funds would be worthless. Back in Germany during the Weimar Republic, you could go into a restaurant and have a nice dinner, buy an expensive bottle of wine. The next morning, the empty bottle of wine was worth more as scrap glass than it had been worth the night before, filled with the expensive wine. And that's the pace at which
gets out of control.
Things can fall apart when it really goes.
Yeah.
I can't tell you precisely how it'll break or when it'll break, but as long as you're protected, and consider too, we're not prepared for this. Again, few countries have been, but you look at Zimbabwe, where you had perhaps the worst hyperinflation anyone's ever seen. It was stretched over a couple of years. Yet the economy continued to function. People got paid at work. what enabled that was that they had a black market in U.S. dollars. The dollars there acted as hard assets for the people. You'd get paid, you'd convert your Zimbabwe dollars to U.S. dollars, and once that had been done, you'd preserve the value of what you had, and you could buy your groceries, pay your rent. We don't have a backup system in the United States. We could have one, and gold would probably serve as a backup. But without that, you're going to see extreme disruption to the normal flow of commerce. Excuse me. As the system breaks, you can see disruption, for example, in the flow of goods to grocery stores.
Yeah.
Nothing will get people rioting the streets more than not having food. You can see civil disorder. I'm not formally predicting that, but you have to take into account that this is a
fuel goes
real
out.
risk.
Yeah, fuel can be very hard to get.
Yeah, exactly. So that what you need to do as an individual, aside from having assets to cover you, is you're probably going at some point, at least for a while, in a barter system.
Yeah.
Is to have in hand a stock of goods to carry you while the barter system it evolves, it becomes developed.
Yeah.
So that you have a couple of months worth of supplies of goods that you need to live on.
Yeah. John, one final question. I know I said I was going to close, but it looks like we're going to go to war with Iran, probably with this Congress and this president, or at least Israel is going to go to war with Iran, because they said I think Netanyahu said he has 7 months till the red line's crossed. That would put this Congress, this president, would be responsible for that, or at least be managing it.
Right.
What does that factor in when you're thinking about this whole thing? Obviously, it doesn't change the economics, but does it change the timing, because it might be a distraction? Maybe everybody runs to the dollar because it is a fear trade.
Well, you had what I'd look at is that it might intensify inflation pressures for a bit, because you might have a spike in oil prices. That's tied to a legitimate supply concern.
Yeah.
And wherever oil prices are, as the dollar takes a hit, they get pushed higher. So that would tend to exacerbate an inflation problem. We had the Arab Spring. This is almost the beginning of 2011. And that was the type of circumstance where you normally get a flight to the dollar. Didn't happen. Instead, it went into gold and the Swiss franc. The dollar at that point had lost its safe haven status. That has happened. Mm-hmm. At the end of the fiscal fiasco back in July, August of 2007, we saw a panic. So the global confidence in the dollar has been destroyed. That's happened. We still have reserve status for the dollar, but central bank holdings of the dollar on a relative basis have been declining. Mm-hmm. It is back in September of 2008, the system was on the brink of collapse. I kid you not. End of the world type stuff. I'm not making that up. You remember what happened there? Nobody seems to care at this point. They didn't resolve a thing. They pushed it down the road. And now we're coming up against a circumstance where we're likely going to see that whole system blow up again. But can the Fed, can the Congress politically do what they need to do to bail out the system? They'll find a way. They'll spend the money.
Yeah.
But they've got to create it. Nobody's going to want to be investing in that. I mean, that could accelerate the process right there.
Yeah. John,
they're not happy times ahead here.
Thanks so much for giving us honesty, and thank you for your research. I hope everybody takes the chance to go to shadowstats.com and subscribe, check out his charts and graphs, and know the truth so that you can prepare your family for the future. Thanks so much.
Daniel, thank you.